Hello, welcome back. So in the last video, we went over the calculation of a pre and post money valuation and the caps table for the first external investor. So now let's say the company has operated and continue to expand. It's now time for round two. So they are going to look for more funding from another external investor. So in this case, again, similar. Uh, we assume that they went with the scenario where they were able to negotiate the number of shares out to 100,000 shares. In this new round of financing, they need $2 million, and the external partner they're looking for is Peer Tree Partners. And in this first scenario, where this is an up round, Pear Tree is willing to invest $2 million in exchange for 50% ownership. So let's work out the numbers and see uh, what does that look like for the owners, the founders, and the early investor, which is GBA. So the number of new shares to be issued is the same calculation we've done before. So I'll just let you go ahead and do that. Um, so we'll need 2 million shares, and oops, that seems too high. I make a mistake. So it's easy to do. It's good to have intuition, which comes with experience. So the number of new shares that will be issued to GBA is 100,000 shares. And the new market value per share will be the $2 million divided by 100,000 shares. So that's $20. So you remember in the last round of negotiation, the market value was $15. Now it went up to $20. So this is an up round. So let's take a look at what the scenario looks like. So we're going to take this from table 3. So the number of shares for Janet actually remains the same. It is 40,000 shares. And the shares for Stephen is 10, and for GBA is 50. So these are taken from table 3. So Pear Tree Partner, this is the new partner. We determined that they will have 100,000 shares. So we can figure out the total number of shares outstanding and compute our caps table. So caps table is just percentage ownership. And always check to make sure that this adds up to 100%. So notice that not surprisingly, percentage ownership for Janet continued to go down. The same thing with Stephen and GBH as well. And Pear Tree Partner, who is the latest partner, now becomes the majority holder. So what we want to do is also compute the post-money valuation. This is a Series A round. GBH was a seed round, so that was the first round. This is a Series A. And the post-money valuation is amount of cash needed. So that is $2 million divided by the percentage ownership that Pear Tree wants, which is 50%. So the post-money valuation is $4 million. So the pre-money valuation, so in this case, we want to be specific, is the pre-Series A money valuation, is the post-money valuation, minus the pre-money, the amount of cash that you raise, is $2 million. Now we can look at what the change in value is. So the change in value is the new number of shares times new market value minus the old number of shares times the old market value. So Janet's number of shares is 40,000 times the new market value, so that's $20, minus the old number of shares, so old number of shares is also 40, times the old market value per share, which is 15. So that's Janet's change in value. So her investment value went up. And the same, if you use the correct absolute and relative reference, you'll be able to copy this down. So if you don't, you can enter each formula individually. Even if you just copy what I did, be sure that you look at the formula and understand what you are analyzing. So what we see here is that Janet's value, investment value went up by $200,000. Stevens went up by $50,000, and GBA's went up by $250,000. Altogether, their overall value is $500,000. Now, let's take a look. The pre-money valuation was $2 million at this round, and before the value is 1.5 million. So it's an up round. The value of the firm went from 1.5 million to 2 million. And the market price, easier to compare, went from $15 to $20. So that's why this is an up round. As I said earlier, in an up round, everybody is happy. Now let's take a look at what happens if it's a down round. So the existing situation didn't change. What changed is the percentage ownership that Pear Tree wants. In the up round, Pear Tree only wants 50% of the firm for $2 million. But in the down round, in this situation, they want 66.67. So they want 2/3 of the firm in exchange for $2 million. So let's go through the calculation to see why this is a down round. Okay, so the number of new shares to be issued is existing number of shares times the percentage divided by 1 minus the percentage. So they want 200,000 shares, which means that the market value per share is $2 million divided by 200,000 shares. So they are only valuing the firm at $10 per share. Before Pear Tree come along, the last time when GBA bought into the firm, GBA paid $15 per share. So it went from $15 per share to $10 per share. So this is a down round. Let's take a look at what happened to the caps table. Now the number of shares, again, this is from table 3. So we're going to go back to table 3. The number of shares outstanding for Janet, Stephen, and GBA remains the same. But for Pear Tree Partners, it went up. So now they will get 200,000 shares. And the caps table now looks like this. So again, just to check our calculation, make sure that everything adds up to 1. So Pear Tree is the majority shareholder. And in this case, because there's no anti-dilution provision, both everybody, Janet, Stephen, and GBH, all suffer losses. Let's take a look at how their losses come out. So first, let's look at the post-money valuation. So this is equal to amount of cash that they need divided by the percentage ownership. So that the company is worth $3 million post-money valuation, and pre-money valuation is $3 million. The post-money valuation minus the amount of cash they need, which is $2 million. So the pre-money valuation is $1 million. Remember that in table 3, the company was worth $1.5 million. So let's see what happened. So we'll take the number of new shares. So that will be $40,000 times market value per share, which is $10, minus, be careful, we're going to table 3 here. So in table 3, we have also $40,000 per share, but the market value per share is $15. So notice that is a negative 200,000. So they lost money, and not surprisingly, because that is a down round. And in this case, they all lose money. And altogether, the company actually went down $500,000 in value. So this is what happened when you experience a down round and there is no anti-dilution provision. In the next video, we're going to go over the example with full dilution provision or full anti-dilution provision and a partial anti-dilution provision.